It's nearly that time of year again. The dreaded self-assessment tax deadline falls in little over a month, and more than 10 million of us need to file a return. Whether you filled one in before or not, the whole process can be somewhat bewildering. But there's still time to get your self-assessment done online, with the final deadline for filing and paying up on 31 January. To help take some of the pain out of the process, we asked Tim Walford Fitzgerald, private client partner at accountancy firm H.W. Fisher & Company, to talk us through everything you need to know. To fill out your tax return online, you first need to register at www.direct.gov.uk. In order to register, you will need several forms of identification, such as your passport or driving license numbers. Your national insurance number will be required, as will your bank details. Once registered, you will have to enter your personal details on the self-assessment form, and then answer a series of questions in order to tailor your tax return to your personal circumstances. For employees, if you pay a subscription to belong to a professional organization, you can claim tax relief on these payments. HMRC publishes a list online of permitted bodies whose annual subscriptions you can claim tax relief on. If your employer pays a mileage allowance below the rate allowed by HMRC, you can claim the difference as tax relief. HMRC's rates are 45p per mile for the first 10,000 miles, and then 25p per mile over 10,000 miles. Most expenses for which employees can claim tax relief must pass the test of being wholly, exclusively, and necessarily for business purposes. So, if you use your personal mobile phone or your home broadband connection for work purposes, because you do not use either wholly, exclusively, and necessarily for business purposes, you can't claim these expenses. If you are self-employed, you can claim for a much wider range of expenses including travel, subsistence, professional memberships and administration costs. Any personal element of those expenses needs to be excluded from your claim. While you can prorata the use of your mobile phone and home broadband, so mobile phone bills can be split, and you can claim a percentage of your broadband use as business expenses. Self-employed people can claim tax relief for software subscriptions, professional bookkeeping software or professional services fees such as lawyers or accountants' fees. HMRC publishes a business income manual online which, while reasonably technical, is fairly easy to navigate, and which may prove helpful. There is an equivalent section for employees' expenses. If you are self-employed and buy equipment such as a new laptop, mobile phone or printer, you can't necessarily claim these as direct expenses. The AIA allows a business to invest up to £200,000 in fixed assets each year. Using the AIA, you could deduct the cost of a new printer from your tax bill, so long as you claim in the year you buy the printer. Cars are not included under the AIA, unless they are hackney carriages, black cabs. For the most part, the AIA will cover the cost of anything you need to conduct your business. People who move to Britain from overseas and earn some of their income from activities they carry out abroad need to declare such earnings. There is a grace period, which applies to overseas employed earnings, and means you will generally not be liable for tax for the first 2 years. This is provided the money you earn from your overseas activities is not brought to the UK or used here indirectly, for example via a credit card. Ultimately, if you do earn some of your income from overseas activities, it is probably best to seek professional advice. If you are a buy-to-let investor, the income you earn from your property must be declared. If you employ a letting agent to manage the property, then their fees can be used as an expense against that income. From this year, the tax relief will disappear at a rate of 25% per year over the next 4 years before it is replaced with a new, less generous tax relief. If you own a significant number of shares from which you derive an income, this must be declared. HMRC allows the first £5,000 earned from share dividends to be exempt from tax each year. A tax charge of at least 7.5% applies on anything above this level, even if you only pay basic rate tax. Should you have made a significant gain from the sale of stocks, shares, land and property or business, this will need to be declared. But you have an allowance of £11,100 before taxes due on any capital gains you made. This section is only going to be relevant if you or your partner have earned more than £50,000 in the last tax year, have children and receive child benefit. If so, you will be liable to the higher income child benefit charge, which reduces the amount of child benefit your family receives the more you earn over this threshold. One way to avoid the charge is to reduce your income through charitable donations to keep you below the £50,000 threshold. Charitable donations can be a useful way to reduce your tax liabilities. It is also possible to make a donation now and carry it back into the previous tax year. Gift aid donations can provide as much as 60% tax relief. If you are retired and have sources of income other than your state and private pensions, it is important to make sure you are paying the right amount of tax on your income. This doesn't include any part-time work you might do, but it does include dividend income from shares or rental income from a buy-to-let investment. In order to get this right, you will still need to declare your annual income from both the state and any private pensions you have. A relatively minor and little-used tax relief is one in which a husband and wife can transfer 10% of their personal allowance to their spouse. If their income in the last tax year was less than the personal allowance, they have been married for all or part of the previous tax year, and their spouse's income was less than £43,000. And that's it. You should now be ready to submit the form to HMRC. Remember, there is plenty of help online, and if you need to check details of something you're unsure of, you can save your progress on the form and come back to it later on. But don't leave it too late. If you miss the 31 January deadline, you will be fined for late submission of your tax return, and don't forget to pay any tax due.